Has you ever thought about gold and the US dollar? I mean, they often seem so interconnected, right? Like two sides of the same coin.
They do.
But what if right now they're actually heading in fundamentally different directions?
That's a really interesting question.
Welcome to the deep dive. This is where we take a whole stack of information, sift through it, and pull out the real nuggets of knowledge for you.
Yeah.
Today, we're really digging into XAUSD. That's gold versus the US dollar.
Right. The classic pair.
We've gone through a ton of expert analysis, and our mission here is really to unpack the complex forces, give you a clear picture of what's actually happening.
And we're looking at it from, well, all the angles. The core economics, the fundamentals, what the charts are telling us, maybe whispering to us, and even the market psychology.
Right.
The goal is really to give you that aha moment. Cut through the noise so you can quickly get why these things are moving the way they are.
Okay, so let's jump right into that main idea then. This deep fundamental divergence we're seeing. Gold seems to be, well, shining pretty brightly, while the dollar, maybe not so much, facing some headwinds.
That's the core argument coming out of the sources, yeah. A profound split.
Okay.
Gold right now is finding some really strong support.
From where? What's holding it up?
It's a few key things piling up. You've got the global geopolitical risks, which seem to be escalating.
Okay, that makes sense.
Then you see increasing demand from central banks. That's a big one. And its traditional role, as a hedge in a stagflationary environment.
That tricky mix, yeah. High inflation, slowing growth.
Exactly that. It thrives there historically.
So that's the gold side. What about the dollar in this divergence?
Well, the dollar's under quite a bit of pressure, actually.
How so?
We're seeing a Federal Reserve that's leaning towards easing policy, signaling cuts.
Okay.
Inflation is still persistent. It's eroding purchasing power. And, the U.S. fiscal picture isn't looking great either. It's worsening.
So quite a few clouds gathering for the dollar then.
Definitely weighing on it.
Okay, so that's the fundamental story.
Yeah.
What about the technical side? Do the charts actually back this up?
They really do. It's quite interesting how they align.
Yeah.
The XAU-USD pair, technically it's consolidating. It's forming what traders call an ascending triangle pattern.
Ascending triangle.
Yeah.
Okay. What does that usually signal?
It typically signals accumulation. Buyers are stepping in at higher lows, pressing against resistance. It often points to a strong upward move potentially coming.
And it's holding above key levels.
Yeah, staying above key moving averages, which is another technical thumbs up for strength.
So if you had to give the overall bias right now, based on all this, clearly bullish for gold against the dollar.
That's right. The current trading bias, looking at both sides, definitely leans towards an uptrend for XAUUSD.
Okay, this is where it gets really interesting for me. Gold. It's not a traditional currency, obviously, but its value just keeps holding, even climbing. What's really driving this momentum right now?
Yeah, it's fascinating. Its value comes from that long history, Store of value, hedge against risk, safe haven asset.
Right.
But several specific factors are really fueling this current rally.
Like what?
First off, a very low real yield environment.
Okay, break that down quickly. Real yield versus nominal yield.
Sure. So the nominal yield on, say, a 10-year U.S. Treasury might be around 4.37%.
Okay.
But core inflation, the CPI, is still stubbornly above 3%.
Boy.
So when you subtract that inflation, the real return, what you actually gain in purchasing power, is closer to 1.79%. And crucially, it's trending down.
Got it. So the actual return isn't that high.
Exactly. And that makes holding gold, which doesn't yield anything, relatively more attractive. The comparison looks better for gold.
And the Fed stance, the interest rate signals, that must play right into this.
Precisely. Huge role. The Fed is signaling it's leaning towards cutting rates.
Right.
And since gold doesn't generate income, lower interest rates mean the opportunity cost of holding it goes down.
Opportunity cost, meaning what you give up by not holding interest-bearing assets.
Exactly. If bonds aren't paying much, you lose less by holding gold instead. It becomes more appealing.
What about all the global stuff? Geopolitics, is that still pushing people towards gold?
Very much so. From the U.S.-China trade tensions, which haven't really gone away, the Russia-Ukraine conflict, ongoing Middle East tensions, even debt worries in Europe.
It feels like a lot is simmering.
It is. And all these factors drive capital towards gold as that reliable safe haven. Not just a quick fear trade, but maybe something more structural.
And central banks. Are they really stocking up? Is that a significant factor?
Oh, absolutely. Yes, it's a major trend to watch.
How much are we talking?
Well, just from the start of 2025 until now, central banks globally have net purchased a pretty impressive 244 tons of gold.
Wow. Who are the main buyers?
Leading the charge are countries like Poland, China, Kazakhstan.
Interesting. And what does that signal?
It reflects this longer-term trend, this kind of de-dollarization, countries diversifying away from the dollar.
Right. Reducing reliance.
Yeah. And this consistent buying, it basically provides a solid floor under gold prices. It's stable demand.
So if you put it all together, persistent inflation, global risks, this central bank demand, sounds like gold's foundation is really solid right now.
It really is. And historically, gold tends to outperform in exactly this kind of stagflationary environment we've been talking about.
Okay, so let's flip back to the dollar.
Yeah.
Given all that strength in gold, what's the situation for the U.S. dollar amidst these currents?
Yeah, the dollar is definitely facing several significant headwinds.
Like what specifically?
Firstly, the Fed. While rates are high now, around 4.25% to 4.50%, market expectations are really strong for rate cuts later this year, maybe 2 or 3 in the second half.
And the expectation alone is enough to pressure the dollar.
Absolutely. Lower future rates make a currency less attractive for yield-seeking investors now. So, yeah, downward pressure.
And the U.S. economy itself.
Yeah.
What are the indicators saying about growth inflation?
Well, the forecast for Q2 GDP growth is only about 2.4%. That's lower than the previous quarter.
Okay, bit of a slowdown.
Yeah. And meanwhile, core CPI inflation, it's still sticky, around 3%. So persistent inflation is still an issue.
Right.
And the labor market, while it's been strong, is starting to show some signs of cooling off.
So slowing growth, sticky inflation. Not ideal for the currency.
Not typically, no. It's a challenging mix.
Are there bigger, sort of longer-term structural things weighing on the dollar, too?
Absolutely. There are definitely structural concerns.
Such as?
U.S. public debt, for one. It's now exceeded 120% of GDP. That's a big number.
Ah, yeah.
And the trade balance remains deeply in deficit year after year. You couple that with some of the domestic political instability we see,
Right.
and these factors start to chip away at the dollar's perception as the ultimate absolute safe haven.
So it's maybe losing some of that unique shine it had.
It seems that way. It's a slow process, but significant.
Okay.
So to sum it up, fundamentally, the scales are really tipping towards gold right now.
Yep.
The dollar looks like it might be facing a prolonged period of, let's say, relative weakness.
Okay.
While gold seems supported by both these cyclical factors we've discussed and these deeper structural shifts.
Right.
And that's really why the analysis points so strongly towards an upward trend for XAUSD.
It's really compelling how the technical picture seems to line up with that fundamental story. Can you walk us through how the charts confirm this bullish view for gold?
Yeah, the confirmation is pretty strong across different views.
Okay.
When you look at XAUSD on multiple time frames, like the weekly, the daily, even the 4-hour charts, you consistently see this upward trend.
A clear direction.
Very clear. And the daily chart specifically is showing that ascending triangle pattern we talked about.
Right, the accumulation pattern.
Exactly. It's classic technical analysis suggesting a powerful breakout might be building up.
Okay, let's talk levels. What are the key resistance and support areas traders are watching?
Sure. For resistance, the first level, R1, seems to be between $3,580 and $3,400. That's the nearest peak.
Okay.
And R2, a bit higher, is around $3,455 to $3,465. That looks like a technical resistance area.
Right.
And the big one, R3, the 52-week high, is up near that $3,495 to $3,500 mark. Could be a psychological barrier, too.
Makes sense. And on the downside, where's the support? Where might buyers step in?
Well, the analysis suggests an ideal buy zone, S1, could be between $345 and $3,365.
Okay, the first support area.
Yeah, and then a key technical stop loss level, S2, would be if the price actually closes below, say, $310 to $320.
The line in the sand.
Kind of, yeah. And there's lower support, S3, down around $3,283 to $3,287, which was the low back on July 9th.
Got it. And what about specific indicators like RSI or MACD? What are they showing?
Good question. The RSI, the Relative Strength Index, it's currently above 70.
Which is pretty high, right? Overbought.
It does indicate strong upward momentum, yeah. But it could also suggest, maybe a slight pullback or consolidation is needed before it pushes higher again. It doesn't necessarily mean the trend is over.
Okay. And MACD?
The MACD, moving average convergence, divergence, that one continues to support the uptrend. Crucially, it's not showing any signs of bearish divergence.
Meaning momentum is still aligned with the price rise.
Exactly. Still looks firmly in the buyer's court from that perspective.
This really begs the question then. Beyond the charts and the fundamentals, what is the actual market sentiment? What are the big players, the institutional investors, doing? Are they buying this story?
That's a key piece of the puzzle. And the latest COT report, the Commitment of Traders report, gives us a pretty clear signal.
What's it saying?
It shows that large funds, the institutional money, the speculators, they are significantly increasing their net long positions on gold.
Really? How much?
They're now holding over 213,000 net long contracts.
Wow, that's a big position.
It's a very strong signal. It tells you that major capital is actively betting on gold prices going higher, following the smart money, so to speak.
Right. And meanwhile, the VIX, that volatility index or fear gauge, it's still pretty low, isn't it? Below 20?
That's correct. Yeah, it's relatively subdued. Below 20 typically signals more of a risk-on environment. Investors feel more comfortable taking risks.
So gold is rising strongly even when the market isn't panicking.
Exactly. And that's what's so telling.
Why is that significant?
It demonstrates this incredibly robust intrinsic demand for gold. Its strength isn't just about a temporary flight to safety when fear spikes.
Right.
It suggests a deeper, more fundamental buying interest, perhaps linked to those structural factors we discussed, like central bank buying and diversification. Smart money might be seeing it as a strategic hold, not just a tactical hedge.
Okay, wow. So if we try to tie all these threads together now, the fundamentals, the technicals, the sentiment, what are the absolute key takeaways for our listener from this deep dive?
Yeah, if we boil it all down, I think there are 4 main points to really walk away with.
Okay. Cool.
1, fundamentals. There's a really powerful bullish undercurrent for gold. It's driven by stagflationary pressures, the Fed leaning towards easing, and that strong global demand, especially from central banks.
Got it. 2,
technicals. The charts confirm this. That ascending triangle pattern, the clear uptrend across time frames, it's all pointing upwards.
Right. 3,
sentiment. The big players, the institutional funds, they're actively buying. They're putting their money where their mouth is, indicating strong market support for gold moving higher.
Okay, makes sense. And 4,
trading insights. Based on the analysis, our sources identify that potential buy zone between $3,345 and $365. They suggest a stop loss around $3,310.
and potential targets.
Profit targets are suggested around $3,450 for a first target and maybe $3,495 for a second. This offers a pretty favorable risk-to-reward ratio, looking like more than 1 to 3. So yeah, that really paints a comprehensive picture of why gold seems to be performing so strongly right now, particularly against the backdrop of the pressures on the US dollar.
What a deep dive indeed. Hopefully that gives you, our listener, a much clearer understanding of all these complex forces, from real yields to central bank buying, and how they all weave together to influence gold and the dollar.
It really does show how interconnected everything is in global finance, doesn't it? How something happening over here can ripple right through the markets.
Absolutely. And as you continue to watch this all unfold, here's something to maybe think about. If central banks really do keep up this trend of de-dollarization, and if the global economy keeps wrestling with this sticky inflation and geopolitical uncertainty, what other assets might step up? What could emerge as the new foundational safe havens for the future?
That's a big question.
And how might that fundamentally reshape, the whole architecture of international finance? Something to ponder.
Definitely food for thought.
Well, thank you for joining us on this deep dive. Stay curious and keep exploring.